Hello everyone, I hope you guys are having a wonderful day, and in this video I'll be explaining how I trade options. What strike price do I look for when I'm trading options? Do I look at any of the Greeks? Do I market order? Do I limit order? And more. So basically everything about options, even with like the IBKR layout, I'll be going over that as well. And a little note to take of is I'm not going to go over any of the basics in this video. So example, if you don't know what a call is, what the Greeks are, what a put, and all those basic things are for the options, then in the description I'm gonna put a link of this free options course. It's an amazing course. It's about 5 hours long, and it teaches everything that you need to know for the basics of the options, like the in the money, out the money, the out at the money, how to read an options pricing table, the Greeks, and pretty much everything that you need for the options. All you need is really the beginner track. For the intermediate and advanced track, it's more about selling options with like complicated strategies such as credit spreads, debit spreads, iron condors, and all those type of things. But personally, I don't really sell options. I'm more of a option buyer and seller, and then just options buy and sell, and then just lock in for my profit basically. So if you want to know anything about selling options, yeah, I'm not your guy because I don't know much about this and I don't have much experience with selling options to collect a premium or anything like that. Okay, so starting off with the table, options chain table, I guess. Basically, on IBKR, on the top left, if you click new window and you scroll down all the way to options tools, you should see the option chain right there. So you're gonna click that, and that's gonna give you this table over here, right? Now, for the settings that we need on this chart table, it depends if we're swing trading or if we're day trading, right? In this setup, I just put everything up, but I'm gonna eliminate things that we don't need if we're day trading, okay? So day trading things I look at are the implied volatility, so I'm gonna keep that here. I need to see the price, the bid and the ask. I need to see the volume, the option interest. Now the only Greek that I care about is delta when I'm scalping, day trading, or whatever. Gamma isn't really important. I'm gonna remove that. Vega isn't really that important, and theta, unless we're swing trading, is completely useless. So I'm gonna remove all of those to make this table a little bit cleaner and easier for as we're day trading. Right, so options chain, go down, layout, and I'm gonna remove theta, vega, and gamma. Perfect. So now see we have the description, the last, the bid, the ask, the volume, the option open interest, and delta. Click apply. And okay, perfect. See, it's a lot cleaner, less data to look at. That's not really relevant to us as day traders. And yeah, so starting with trading options. Basically, I'm gonna go on trading view over here with NVIDIA. The way that I trade options is basically exactly the same thing as if I'm trading stocks, stock shares. So all my plan, all my technical analysis is done on the stock chart. So in this case, it's NVIDIA with its price over here. The only difference is the instrument that we're trading, right? So instead of trading stock shares, we're trading option contracts. Just a quick reminder that options give an added leverage, which means it's a high risk, but also high reward. If used correctly, it can give you high potential returns. But on the other hand, if it's used incorrectly, you'll probably blow your account like nothing. Like it'll just burn off, like even faster than stock shares. I'm sure it probably happened to some of you guys, where if you just didn't know anything about options, you just bought everything and you probably blew your account in like less than a day or lost a huge amount in one trade, right? So it's a double-edged sword, but a big advantage is you don't need as much capital. Like let's say example, if you wanted to buy 100 shares of NVIDIA, it would cost you about $27,000 right now to buy 100 shares, right? But in an option contract, I can literally just buy one contract for what, $335? and with that, I can easily make $1,000 with that, right? As opposed to having 100 shares, the stock has to go up $10 for me to make $1,000, right? And yeah, so you need much less capital, and I feel like most people who trade large caps mainly just use options because like you can make way more with less capital, and without leverage, like you can make a lot of money, which is really good. What else am I gonna look at? Right, okay, so I'm gonna show an example of exactly how to trade the option in this scenario, right? So let's say I'm looking at NVIDIA currently, right? We have a demand zone here. Price seems to be reacting around this area. We can see that price reacted, pushed up over here. So let's say if I'm trading, I'm gonna wait for price to come back into the zone again. Nothing. Okay, so we touched the zone. What's gonna happen now? Boom. Alright, so we touched the zone here. And let's say if you're normally entering the stock, you enter the stock at 270.26 here, right? And maybe let's say you have a tight stop loss at 269.49. So I'm gonna do this right now. And right over here, put a stop loss right below that low of that candle over here. I'm gonna put it here so it's a little bit easier. There we go. And let's say we're aiming for a 1 to 3 risk reward ratio. So we're risking 75 cents and we want to make a 3 to 1. We want to make, wait, what? Oh, right, yeah, sorry, yeah. So we're risking 75 cents and we want to make $2.25, right? And let's say in the analysis, whatever you're looking at, maybe it's going to be double patterns. We're going up, going down, going up, going down, and you're probably expecting the stock to come back over here, right? Oops. I'm going to delete that and redo it. Let's put that down, pulling back up, pulling back down as a double bottom, and maybe we're going to push back all the resistance here, right? But let's say you're aiming for just, 1 to 3 risk reward ratio, because that's a really good trade if you get it through a 1 to 3 risk reward ratio. So now, as I'm about to pick this contract here, okay, like it's not as simple as like stock shares where like the stock is at 270.30 and you can just click buy market and boom, you're in, right? All I have to do is just click sell, right? For trading the options, there's a little bit more steps to that, but really it might seem complicated now, but it's honestly like really easy to pick the options. So first things first, we have to pick an expiration of when the contract is, the expiration date of the contract basically, right? If we are day trading, I typically pick the contract that expires the same week, so the Friday of the week. There's exceptions, which I will get to. Basically, if it's Monday to Wednesday, then I will trade the same week expiration contract, right? So today is Tuesday, January 11th, which means that I will pick the contract expiring January 14th, 2022, right? Now, let's say if it's Friday, so let's say if it's January 14th today, then I'm not going to pick January 14th. I'm actually going to pick January 21st, so that's next Friday expiration. You might be wondering why. Well, the reason is because of theta. So especially on the last day, the last day or the last 2 days before the contract expires, theta tends to increase like by a lot, like it really accelerates, which means that if the stock doesn't move in your favor at all, you're gonna lose value just by the stock not moving as much. So if it doesn't move in your direction, you're probably gonna lose money, right? So let's say if the stock is going up here to 276 to 277, perfect, you're making money, right? But what if the stock was consolidating like over here, not going up or not going down? Then during this time you'd actually be losing money, ironically, right? So if let's say I bought the options at 269.83 here and the stock goes up at 271, yeah, in stock shares you'd be making money, right? Options as well, right? But let's say you pick the same expiration and when pulling back here in this area here, right, in this area here, and the stock is not moving up or not going in your favor, the premium cost is actually going to go down. So even though the stock isn't moving here, let's say, remove this. Let's say, right, the stock pulls back over here, right in the middle of my circle here, right? Well, since it's the same day and theta is eating away at your options premium, even though you bought at 269.81 and the stock is, let's say, at 270.85, that's probably your break even. So the price went up, but the contract dropped in value. So you probably break even, right? And the longer it stays in this range, eventually you're probably going to be losing money because it's staying in that range for so long. So let's say you bought the contract here, maybe the price of the stock is going to have to go to VWAP for you to even break even or make a bit of money, right? And that's crazy, right? Stock shares, right? You don't have to deal with theta or any expirations, right? This is your break even here, 269.82. If it goes up to 272, you made money, right? Regardless. Option contract is not like that, right? The stock go to 72 and somehow you're still losing money. That's one thing. Those are one of the things I don't like about option contracts. But yeah, just so that you're aware, right? Next. So we got the expiration date. Today is Tuesday. I'm gonna pick the contract that expires on Friday, January 14th. Next, for the strike price, I generally go at the money or a bit out the money. I never go in the money, okay? Which means that if, let's say, we enter here the price of that beautiful engulfing candle here at 270.86, then I'm probably gonna buy the option contract for the strike price 270 or above. I'm not gonna buy any more in the money. I'm filming after the market already closed now, and the at the money is at Nvidia is at 280 currently right now, so that's why it might not make sense. But during the day, the 270 is actually gonna be in the middle here for the in money, and then 280 would have been like out the money, where like the 290 is, for example, right? So, things that I look for when I'm day trading is I want a delta of at least 0.30. Now, why 0.30? It's because it's enough that when the stock moves in your direction, you're gonna make money. If the delta is too small, like in this case here for 290 strike price at 0.17, you're not gonna be making that much money when the stock moves in your favor, right? Just keep in mind that delta is how much money you make when the stock moves $1 up, or how much you lose when the stock moves $1 down, right? So if its delta is 0.53 and the stock goes up by $1, you made $53. If the stock drops $1, you lost $53. Now, what a lot of people think about at the money options is don't do them. They're really bad. Or the stock is trading at, let's say, 270, and you want to buy a stock price at 275. You're going to be losing money, right? That's not really the case, right? Because it's not like we're keeping it or exercising the option, right? You can still buy out the money, right? Not only they're cheaper, and you risk less money. Just don't go way too far the money, right? Like I said, keep the 0.30 delta, right? Because even if the stock goes up, the value of the option contract is also going to go up, right? And why do we go in the money? Reason is, look, like example, if you go in the money with a 270 strike price, which is in the money, this option is $10.40 here. So 100 shares, that's $1,000 there for an option contract. And delta is 0.74, which means that not only are you paying more money for the contract, for the premium, if it goes against you, you're going to be losing a lot more money because delta is so big, right? So it's not really worth it. So that's why usually I stick at the money, or I go slightly out the money, right? But just remember risk management, right? You should be risking about 1 to 2% of your account per trade, right? Options, I like to be a little bit more aggressive and risk 2 to 3% of my account since they're a lot more volatile. So let's say you got a $10,000 account, right? 2% of that is $200, which means you can only risk $200 per trade. Now, as you're selecting the strike price, all you need is the option to be at least 0.3. This is really close, so I'll count this here, right? And with that, I'm also like looking at the volume and the option interest. Now, usually when we play popular stocks like Nvidia, like volume, there should be plenty of volume, right? But usually, the more the volume, usually is the better contract to pick. Even though like this is not a 0.3 contract, I'd still pick at the money here. This is due to like a lot of volume, right? And usually when there's a lot of volume, it means a tight spread. So like in this case here, look, the ask is 4.4 and the bid is 4.35. So that's only a 5-cent spread, right? So let's pop that 100. You know, that's only a $5 move, right? So sorry, not $5 move, a $5 spread. So if you buy at 440, you're gonna be down $5, right? The next thing I look at is the option interest. Like I said, those two are really important because if not that many people are holding the option or there's not that much volume, not only the spread is going to be huge, like over here, look, right? Volume isn't that big, open interest is very small. Look at the spread here, 12.20 for the bid and 12.60 for the ask. That's a 40-cent spread. So $40, right? You'd be buying here at the ask and you'd be down $40 for one contract. Imagine if you bought 10 contracts, you'd be down $400, right? So that's not a very smart move. Sorry for the message. Right, so that's that. And then with the delta, going back to the risk to reward here, let's say you can only risk $200 for that 2% move. Well, let's say if you bought one contract at let's say 277.5 strike call, then if the Nvidia drops at $1, you'd be losing $50, right? So in this case here, a stop loss is 75 cents. So we're gonna round this to $1, right? So we'll say about if a stop loss gets hit, we're gonna lose about $50 here, right? So if you can risk $200, here's what you can do: you can buy 4 of these contracts at the 277.5 strike calls, right? Because we're betting for the stock to go up, and then you'd be losing about $200, right? Or you could also go more out the money, buy cheaper contracts, and let's see if it's $30, that would write 0.30 cents for the delta. Then if we can only risk $200 per trade, that's, let me do a quick calculation quickly. Then we can buy 6 contracts of the 285 strike price call here, right? So you can buy more contracts. So it's a mix of both, right? When you go too much at the money, it's more expensive and delta is bigger. Or maybe you want to purchase more contracts and get it for a cheaper price, right? Usually when you go out the money, it's a bit riskier, but it's more rewarding, right? Because think about this, right? In here you can only buy 4 contracts at 277.5 strike price. When you go out the money, let's say the 285 strike price, you can buy 6 contracts, right? But don't forget that since this is out the money, when you go in the money, when it starts becoming purple, the delta is going to increase by a lot. That's where, like, when you're in the money, the option is really going to start increasing. It's going to give you that boost, right? So that's why I usually like to buy slightly out the money where it's not purple, so that when we get in the money, when it becomes purple, the premium usually skyrockets, since like it goes in the money, right? So in this case here, let's say going back to this example, so we're getting at the stock at 270.78, 270. I'm probably going to go a bit out the money, so I'm probably going to go around maybe 275, right? Even though our price target is at 272, it's fine. We're still going to make money anyways, right? And in this case, keep in mind that what was I going to say? Yeah, keep in mind that the stock has already moved here. So when technically 70 is already in the money, which is why it's so expensive. But during the day when we were at 270, it was probably around $4.4 here. So $440 during the day, right, for one contract. And if I go 275, probably costs around $255 for that one contract. So then what do I do now? So let's say we're gonna go to this example, okay? Right, so 270, I'm gonna pick a 275. So what do? I go on my option chain here, option trader, and I'm gonna click on the ask at 10.275. Oops, 275, right? So here, that's gonna show the bid and the ask, and I have this chart here which tells me what the options price was, like during the day, right? So if I scroll back during the day at, what time is this trade at? 11. Move left to 11. Gotta look more left. There we go. See, so at 11, option contract was about $450, we'll say, $4.5. In this case, so let's say if we bought that here, right? So I click on the ask. For options, I generally limit order. Like I usually just click the ask and then get in. If the spread is very tight, like here, like it's like $5, not even, I just market order in because the spread is so small. And let's say if I'm chasing the option and I want to get in hurry, then I'll just market order, right? But let's say if the spread is where, like over here from 12.2 to 12.6, I'll probably try to limit order for the mid price here. So I'd probably like 12.4 if I can get filled in between, right? Or if I want to buy on the ask, I limit buy on the ask, but not market, since I probably will get screwed over in this situation, right? So let's see how this trade went, basically, right? Boom, right? So that trade was a very good trade, and you would have gotten 1 to 3 risk to reward ratio here. So let's say we broke this price here, we hit our price target here at 11.02. Let me move a little bit more. Why is it not showing, right? 11.58. There, right? So let's say if you buy that option at $4.4, right? At 11.02, the option went from $440. Sorry, I keep saying multiply on. We went from $4.4 to $5.8, right? Which means that we went up about what is it? I'm gonna use my calculator quickly. 5.8 subtract by 4.4. We would have made about $1.4 for that contract. So with about 100, we would have made $140 for that 275 strike price call, which is amazing. Like imagine that, right? The stock only moved from 270 to 272. We moved $2. Imagine if you would have bought shares, right? Let's say you bought 100 shares, it would have costed you $27,000, and you would have made $200 still. But it took you $27,000 to make them only $200, right? The option contract with only $4.40, you made close to $150 with that, right? So you see how much better that is in this situation. So that's the power of options. I'm not going to go over the level 2 here because that's more for like the trading. It's mainly just the options. But yeah, right? Like you can see how powerful options are if you do it the right way, right? Problem is, what if we didn't go up $2, we went down $2? Then you would have lost about $150 on the opposite side, right? Like if we hit a stop loss here, if we drop $2, right? So in this case, we were risking about $1, so $50 to make $150, right? So that's a good 1 to 3 risk to reward ratio. And I don't know, let's decide to hold the option a little bit longer. To that resistance, boom, clean resistance break. Alright. I'm just gonna get rid of the replay now. I'm gonna go around this price here, right? And let's say you decide to hold all the way here from 270 to 280. So that's a 10-point move, $10 move. Look how much the option went up by. What time? It's 11:45. Wow, go away. How do I do it? Hello? I'm just gonna give it, there we go, okay. 11:45. Look, the option went all the way to $8.8. So it's worth $880, which means you would have made 100% on the option contract, right? You would have bought at 4.4. Now you would have sold at 8.8, right? So that's $440 to $880. You would have made literally double, right? $440 with only one contract of $400, right? And let's say you bought two contracts, you would have made about almost $900 for just a $10 move, which is really good, right? Let's say you bought 100 shares here at the bottom, $10 move, and you bought 100 shares, right? You made $1,000, but remember you have to put $27,000 in capital here, right? And even if you move the dollar, like, yeah, you made $100, but like the option contract, you can buy way more, right? Like, imagine if you bought $27,000 worth of options here. How much could you have bought? I'm gonna do a quick 27,000 divided by 440. You could have bought 60 contracts. Imagine that, 60 contracts for $27,000, and do 60 multiplied by, went up by $440 profit each. You would have made $26,000 for a 10-point move. As opposed to with the capital, you only would have made $1,000 with $27,000. Wait, what? Yeah, you only would have made $1,000 with only $27,000, which is insane, right? It's a lot of money. You only made $1,000 for $27,000. What if you bought $27,000 worth of options? You would have made $24,000. Pretty crazy, right? I think the last thing to go over is, right, selling the option, right? So when you sell the option, right, when you click that, when you bought the option, right, it's going to select the correct contract and the correct strike price. It's going to say what price. I usually try to limit order and try to sell at the ask. So sell into the momentum push upwards, so I can sell it for a better price. If I don't get filled, yeah, honestly, I could just market order. It's gonna go straight to the bid, right? But usually I try to get more, so I try to sell at the ask, if possible, basically, right? So yeah, that would have been an amazing trade here, right? Very good money, and if you keep that risk management well and you decide to size up, right, you can make a lot of money with options, right? Anything else I need to go with? Implied volatility. Usually it depends for what stock, but for Nvidia, 50 to 60% is usually normal. If the implied volatility is anything like 80 to 100% or more, I wouldn't even trade the option contract. And pretty much that's due to not only implied volatility is going to hijack the option premium, so you're going to pay way more for the option. If the stock goes in your favor, let's say you bought a call and the stock goes up, right, you're going to be making a lot more money because implied volatility is so high, right? But as soon as the stock stops moving in your direction, or like it stalls, or like it pulls back, you're going to be losing a lot of the value of the contract. And that's what happened to a lot of people doing the GameStop squeeze, the short squeeze, where the option implied volatility was like 300%, 400%, 600%, right? Which means if the stock goes up, you make so much money. But as soon as it pulls back at like 600% implied volatility, you probably lose about 90% of the option value premium, just because of a tiny pullback. And that's why it's so risky with options. So even in that case, I probably just buy stock shares, so I wouldn't have to deal with all of that. And I think I went over everything for the options. So if you have any other questions, just message me. Maybe I hope I clarified most of the things about how to trade options. And honestly, they're not that hard. Maybe the beginnings might be confusing, but usually, like, as you're entering a trade, you already know you have everything selected already, right? So if I'm getting 270, I'm gonna look at 270 or above strike price, right? I'm gonna look at the volume, the open interest. If there's a lot of volume here, perfect, right? I'm gonna pick the delta above 0.3. Volume with the most volume usually has the tighter spread, so I lose less money if I market order in. And yeah, basically the more volume the stock has, like let's say one of the best stocks to trade options with is the SPY stock. It has, I think it's the most option volume trade stock, and the spread is extremely tight. It's like a 1 cent spread. Yeah, I'm gonna show you quickly. I'm gonna go on SPY, and that's why a lot of people trade options in SPY, because they're very cheap for like small accounts. You can grow your account very quickly. And look at this, 109,000 volume. Nvidia barely had 3,000 volume today, right? And even if you look at the spread, look, the bid and the ask, 1.5, 1.51. That's a 1 cent spread. So you get in, you're only going to be down $1. You can easily just mark an order in, right? You don't want to have to limit because the spread is so tight, right? It's not like Nvidia earlier where you saw that 60-cent spread. You'd be down like $60, right? Which is why a lot of people, if you trade SPY, like it's pretty easy to just mark your order in, since there's so much volume and so much open interest. And yeah, so that pretty much wraps the video up. If you have any questions, just message me. If you need clarifications, just message me as well. Just letting you know that, right, options or large caps. So if you start trading options, you're gonna be essentially specializing with large cap stocks, the blue chip stocks, not really the small caps and the penny stocks anymore. It's an adjustment, but usually everybody has their own personality, their own style. I do both. I trade both small caps and large caps. I think I'm leaning much more towards the small caps now, because the commissions for options are quite expensive here in Canada, and for my age I can't use interactive brokers for the options, which really sucks. And oh right, oh my god, I keep forgetting, sorry guys. Options, right, are very volatile, so they're pretty much like basically penny stocks before the contracts. Like, they move very quickly. So it's almost like if you're trading penny stocks, like small caps, before the large caps, but a little bit more complicated since it's option contracts as opposed to stock shares. There we go. Okay, so that concludes the video. Have a great evening, and I'll see you in the next one.